capital is no longer really cheap and the market is very cyclical. And so for younger investors like me who joined sort of at the nadir of the market, we've been taught in one way, but for more experienced investors, this is one of 4 or 5 cycles that they've seen over the course of their careers alone, right? So it's just, I think, riding the wave and figuring out what a sensible price looks like and taking the big shots when you feel them.
Welcome to Pioneers, the show where we explore the intersection between humanity and AI. I'm your host, Ankur Patel. Over the last 10 years, I've built 3 AI startups, written 2 books about the subject, and I run a weekly AI newsletter. I also regularly teach and speak about the topic at conferences. This technology has grown faster than I think any of us could have imagined, and it's making us ask really important questions, such as how ethical is AI? What will this technology look like in a few years, let alone a few months? And most importantly, does it have the power to truly change the world? And what does it mean for you? On this show, I'll be interviewing the founders, operators, and pioneers that are introducing AI into their companies and industries. We'll be asking them the really heavy-hitting questions that make them dig deep into the core of what we do. And without further ado, let's dive into today's episode. Welcome back to the show. I'm your host, Ankur Patel, and today my guest is Lulu Chang, an investor at Canapi Ventures. Lulu, welcome to the show.
Thanks for having me, Ankur. Great to be here.
Well, to start off, I know you have a somewhat atypical journey into venture. So could you tell the audience how you got into venture in the first place?
Totally. I like to think of it as a very circuitous route. So I started my career actually in comms and in marketing, first at Squarespace and then at blockchain.com. And then after business school, did a couple of years at McKinsey before joining the team at Canapi. So I've done the operating side of the house. I've done a little bit of the consulting side of the house. And when Canapi asked me to join, I said to them, I don't know that you've got the right gal because I have neither any fintech experience nor any investing experience. But if you're willing to take a chance on me, I'll take a chance on you. And it's been just over 3 years and they haven't fired me yet. So I think so far we're doing okay. But I've always said that the transferable skill set, shockingly, from comms and PR to venture is stronger than you would think.
A typical read, the hot take here is some investors argue that not having an operator background is really helpful because you're just able to look at the hard data and then invest that way. And other investors, they say having an operating background allows you to empathize a bit more with the founders and what they're going through. I'm curious, what's your take on all of this?
I mean, I always chuckle a little bit when people say, or I say myself, that I have an operating background because that is so generous of me. I operated, quote unquote, for all of 3 years as an early 20-year-old. And so I wouldn't say that I have the COO or VP of strategy operating experience that most people are thinking about when they say that operating really helps. But I do think that that is the case. I think that understanding what it's like to run a business from the ground up and really at the ground floor is really important. You know, one of the things that ultimately didn't sit so well with me in consulting is that you are at the very least N-1, if not N-5 or 10 from the actual finished product. And in venture, you get a little bit closer, right? Because you really are, forgive the metaphor, but in bed with the companies that you invest in for the long term. And so you're standing more in a shoulder to shoulder manner, but nothing really compares to actually being in the company and knowing that your direct decisions on a day-to-day basis really make an immediate tangible difference. And so I think having that perspective is really, really important and hopefully makes you a better investor.
I'm curious, the McKinsey background and consulting in general, do you think that really helps when it comes to having the right mindset being on the investor side of things?
I think the best thing about a firm like McKinsey is that it really teaches you how to structure your thoughts and your work. I think I say this about college as well, right? You learn how to learn. And in some ways, McKinsey teaches you to think in a particular way, which in some cases is great and in some cases is less great. But I think from an investing lens, having a really clear roadmap of the types of data that you want, the types of questions that you need to have answered to, and then having a very linear way of getting from point A to point B in terms of, hey, if I get this answer to thing A, then I get to move to point B. That's really, really helpful.
What about your time at All Raise? Could you maybe give us a little bit of background on what that is and how you think about female representation in venture?
Yeah, of course. I'm so glad you asked. So When I graduated business school in 2020, that was, as I'm sure we all know, at the very beginning of the pandemic, and everybody was very confused and not sure of what to do. And McKinsey actually ended up pushing out our start dates for a little while. And so me, instead of doing the smart thing and saying, great, I now get an extended vacation, thought, oh God, now I have to figure out something else to do. And so I was actually put in touch with the All Raise team, and they were looking for a business intern. And so I got involved really at the HQ level and was just so impressed by the work and the mission that they have of really increasing female representation, both on the founder and the funder side. And so I stayed involved in some capacity. And I think that that's a big reason that I actually got the job at Canapi, because folks looked at my resume and thought, All Raise, she must be somehow involved in the venture community, even though that was not technically the case. And so, I think over the last 4 or 5 years of being involved, now more as a volunteer and not at the HQ level, it's really meaningful to see the types of bonds that the organization is able to facilitate amongst female investors. And deal flow in this industry and network is really part and parcel of success. And, in an industry where women are still enormously underrepresented, both on the funder and founder side, having a group of folks who look, sound, and probably come from more similar backgrounds to you than the average person in venture is really important. And I think results in better outcomes, both for firms and for companies to have. There's so much data that shows that diversity is key to success at the organizational and at the board level. And so I think All Raise is just one small part of what the ecosystem can do to improve itself there.
I'm also curious because a lot of founders come from deeply technical backgrounds or product backgrounds. And perhaps there isn't as much go-to-market or marketing or communications DNA among a lot of founding teams. So I'm very curious how your background in marketing and communications has helped you really share more intelligence and know-how with founders that are in the early stages of company building and perhaps haven't made a senior go-to-market hire, but are still trying to be in the market and actually sell to a lot of the audiences there.
When I first took my PR comms job, I thought, classic, what a pink collar job, right? That's actually what it's called, because it typically caters to women, young women in particular. And I did not think that this would be truly a particularly transferable skill set or one that would serve me well in the long term. And I was so wrong. I think that it is truly one of the most underappreciated and undersold skill sets that you can have, both as an investor and I think as a founder, because at the end of the day, everything is storytelling, right? And being able to craft a really moving and compelling narrative about, from a founder perspective, right, why it is that your product or your service is solving a very distinct pain point and why it's doing that better than anybody else. Being able to tell that story, I think, is 90% of the challenge, especially in the early days, right? Because before anybody's even willing to demo your technology, they want to know, well, what do you do? Yeah. And if you can't tell them, if you can't explain that to them, nobody's really going to give you the time of day to show them. And then on the other hand, right, for the funders, capital is capital. It's ultimately incredibly fungible. And so when you're talking to a company that is in very high demand from every investor in Silicon Valley, being able to differentiate yourself, not only as a fund, but as an individual investor is also incredibly important. And that's just one big marketing ploy and communications ploy in and of itself. So, I think recognizing the importance of those skills is really, really critical. And even just explaining that to founders at an early stage, I think becomes a little bit of an unlock for them, whereas they previously just think, well, we need to spend all this money just getting the technology right. And that's great. That's definitely true. But you got to do some of the soft stuff too.
I completely agree. I think being able to message and market appropriately early on is you're able to get in the market a lot sooner, you're able to generate revenue, you're certainly able to get more feedback from the market around how you're positioning the product, how you're talking about it. And I think if you start too late, you might have a beautiful product, but then you have to have go-to-market catch up, and that could be really frustrating, especially if you're a couple of years in where you've raised capital, kind of everyone's kind of waiting for that the sales and revenue to pick up, and it doesn't because you have foundational work that you need to do on the go-to-market side. So I think more and more founders, I think, are becoming aware of that, particularly if it's a second-time founder. And I think it also helps, I think East Coast and particularly New York mentality around some of this is a little bit different than perhaps the Bay Area, where I think the Bay Area is much more, and again, they've built legendary companies, but it's much more focused on build the right product and then go and find ways to sell it. in New York, the mentality is very numbers and metrics driven, right? So I think that does tend
Yeah.
to be part of the DNA a lot sooner than it would otherwise be.
Yeah, I think if you build it, they will come is true up to a point, right? But they need to know what you've built and why what you've built really matters. So I think exclusively resting on the laurels of an amazing product can be really challenging. And we see that every day from the investor seat, right? We meet with a lot of amazing companies that have clearly built really compelling technology. But if you have a founder or a face of the company or a voice of the company who can't really clearly articulate what it is that they've built or how they've built it or why it matters that they've built it, it could be the best thing in the world. And, you just getting that message to really land is harder than it seems sometimes.
Yeah, sure is. 2 years in, it seems like now, right? Since ChatGPT.
Hey. Oh, two, sorry.
Yeah.
I'm still thinking about me.
No. No, I meant to say we're 2 years into this AI wave with at least ChatGPT hitting the consumer mindset with their release in November 2022. So I'm very curious at this point, 2 years in, if you look at your portfolio, look at opportunities in the landscape, what in AI is really playing out well and what's disappointed to date?
Yeah, that's super interesting. So I think what has played out well or appears to be playing out well is really AI as it relates to compliance. And, we've talked about this a little bit before, but we've seen, especially in, I would say, recent quarters, an increased interest both in AI for compliance and then also compliant AI, which are not the same things, but are two sides of the same coin. And so I think they sort of illustrate the push and the pull of this technology, right? Because it's been such a leapfrog in terms of capabilities, I think that there is a natural hesitation around too rapid adoption, right? Especially for financial institutions, like the ones that we work with a lot at Canapi. And so on the one hand, you have financial institutions who are really excited by the idea of transforming a historically very manual, very cumbersome process with either AI agents or AI co-pilots. But then on the other hand, you have regulators who are a little bit wary of all of this, or maybe a lot bit wary of this and saying, hey, it's great that you can do this a lot faster, but we still need to make sure that you're doing it correctly, that you're doing it fairly, that you're doing it ethically. And so seeing the tension between those two things has been really interesting, but it's definitely been where we've seen a lot of activity. Where I think things have been less, I think we've gone on sort of a meandering journey here. So I think that for the first time, chatbots are really, really taking off in a meaningful way, right? I think that voice AI and really having these voice assistants in this generation of AI is actually taking meaningful steps forward. But I think, if you look back 2 or 3 years at some of the quote unquote AI chatbots, those really don't hold a candle to what we have today. And I'm sure that if we fast forward another 3 years, today's AI agents or voice agents maybe won't even hold a candle to that next generation. So it'll be interesting to see how that all lands.
What about use cases like customer service, right? That's been one of the hot areas. And I guess the real logical question here is, if customer service is a hot area and there's more adoption there, is it a defensible area for companies to build in, given that perhaps maybe the base capabilities to do customer service are getting better and better over time?
Totally. No, I think that's a great question. And really, when I talk about the chatbots and the voice AI, that's precisely where I'm going, right? I think that hopefully what AI allows us humans to do is more creative, high touch work better, right? It's really meant to do away with the mundane, the rote tasks, and instead free us up to do hopefully what humans do best, which is the actual human touch and the actual human interaction. And so I think in customer service, it will be interesting to see where AI can really imitate and perhaps surpass the capabilities of humans on certain very low level tasks, right? While recognizing that at some point you're going to need to pull in somebody else to really take things up to the next level. But if you can give customers a really delightful experience, which I think increasingly is possible with AI, and you're doing so for less money, for less amounts of time, right? Because instead of having to wait on the phone forever, you can still seemingly talk to somebody and get a real answer. I think that's incredibly powerful.
What about this messaging around like even AI agents, right? So maybe just a little bit of a frame is, you could argue that AI agents is selling a unit of work where you're actually performing work that would have been done by people. And so you're really pricing and selling unit of work, even though it's AI powered and AI driven through these AI agents, versus just selling in the traditional software way, which is like it's software to help you get an AI agent built, and you're charging it more akin to software versus charging for the unit of work being done. So how do you kind of see the two? Is there a difference between the two?
We'd have to ask procurement at one of our LPs. I think there is a difference. Maybe the better way for me to think about it is just what ROI looks like as a result, right? So where are you actually saving the money? Is it on the human cost? Is it on the labor cost? Or is it in the quality of the output? Is it in the actual work? And how do you quantify that? So I think it's a really interesting lens to put on it because it's not quite the same thing. It's really not the same thing at all. And then the question really becomes, all right, then how are you ascribing value to the thing that AI is actually doing, right? And I think that is a paradigm shift that we haven't had to do in quite a long period of time, right? But when you think about SaaS and the evolution of software as a service, that's sort of the same thing. How do you ascribe value to the work unit that is the software versus the package, I suppose?
Yeah, it's very interesting because even in software, it used to be seat based, like that was the primary way where you would charge. Now you may have fewer seats, and seats may be not the best proxy, and so it's really some sort of consumption or usage based, and usage being aligned to actually the unit of work being performed. And so it's a tricky thing to kind of get that out in the market because it requires a rethink around how you price a product and how you kind of pass it through procurement. But I agree with you. I think at the end of the day, it's all ROI driven. So if you could quantify the impact and show the impact and then align that, people would be happy to pay 10x the cost. If they're getting 10x the ROI of some cost, they'd be happy to pay a higher cost for it, right? It ultimately has to just be a fraction of what it would take them to cost otherwise to do. So it's very interesting to see the paradigm shift around pricing and packaging and such.
Yeah, no, and that's definitely something that we're noticing with some of our portfolio companies, or even in just thinking about the companies that we're evaluating, right? Because you're totally right. With AI, it's not necessarily a per seat basis. And so that is a bit of a shift in how we think about pricing power and how we think about expansion opportunity, right? Because historically you're just like, oh, great. The more seats you have, the better the technology, right? But that may not actually be the case with some of these newer pieces of software.
So for the benefit of the audience, could you describe some of the LP base at Canapi? And then I'd love to kind of dive a bit more into how they're thinking about some of this software.
Absolutely. So Canapi, what really makes us unique is that our LP base, in addition to your traditional family offices and institutions, also comprises about 70 banks across the US. So on the bigger end, folks like Truist, US Bank, Huntington, Ally, all the way down to your smaller regional and super regional banks like Bank of the Ozarks or Martha's Vineyard Bank, right? And so what that gives us, we like to think, is a bit of a dual value proposition, dual mission. So on the one hand, to our banks, we say, hopefully we can make you some amount of money off of the $1.4 billion that you've invested in us to date. But just as, if not more importantly, here's this really innovative roster of companies that can improve your fraud stack, your payment technology, your cyber posture. And so effectively the mirror image is true to our portfolio companies or prospective companies, right? Here's strategic capital, but oh, by the way, if you want to sell through or partner with a bank, we can help you do that. So if you look across the 30 odd investments that we've made to date, we've helped sign just over 100 commercial agreements. So we really pride ourselves on not only making those warm introductions, but actually ensuring that these are real revenue generating opportunities. And part of the way that we do that is by having pretty regular touch points with a lot of our LPs and saying, hey, what's top of mind for you, right? What pain points do you have? What opportunities do you see for technology to enhance or positively disrupt what it is that you're doing?
And I think the common thing that a lot of investors and founders believe is that a lot of these regulated spaces, the players in regulated spaces, they tend to only work with startups that are later stage, right? Maybe Series B on the early side, but later stage generally. And we had Peter Hung from Illuminate Financial, whose LPs are also a lot of FIs, mentioned that some of their LPs, I'm curious about your LPs here as well, they're much more inclined to lean in a bit earlier with startups, just because I think the youngest batch of startups, they are the ones that are maybe in some ways most innovative, especially around newer technologies like Gen AI. So I'm curious if the appetite to go and work with startups has changed among some of your LPs.
It's definitely a case-by-case basis. I would be remiss if I said yes. Across all 70 of our LPs, everybody's really excited to partner with pre-seed and seed stage companies. That's definitely not the case because, no two banks ultimately are really the same. There are absolutely some of our LPs that are really excited to be design partners at the very earliest stage or who even incubate companies of their own, right? And then there are other companies or other financial institutions who, as you mentioned, Ankur, are much more inclined to work with Series B and beyond. One of my favorite/least favorite quotes from a CISO that I work with a lot is, "We want to know what the bleeding edge is, but we don't want to be on it," which I think for some banks really encapsulates their position. But that is not representative of the entire ecosystem. And again, I think in light of the election and what that could mean for the regulatory landscape, it is very, very possible that banks will be willing to experiment a little bit more. I think the one thing to keep in mind with a lot of banks, still not all though, is that you don't have all that many chances, right? Banks aren't going to say, "Oh, you didn't quite get it right this time, but let's keep trying every 6 months," right? In the same way that some other, or even investors, right? If the pitch didn't land 6 months ago, pitch me again in 6 months. I don't think that's quite the same with a lot of banks. So you do want to get your first pitch as well honed and well heeled as possible. But in some cases, that pitch could be from a seed stage company just as well as a Series D.
Yeah, I mean, I think many are very open to having conversations, but I think at the end of the day, these are regulated spaces. They are in the business of managing risk, and one of the major risks is working with a startup that is too early on, maybe hasn't gotten their ducks in a row. Maybe there's existential risk of them existing or not, or maybe they haven't worked with enough other companies that are in the regulated spaces, and therefore there's a security or compliance vulnerability, right? And so I think startups that sell into regulated spaces have these long, lengthy cycles, and they need to have everything kind of dotted and teed up in order to go and get into the large financial institutions, especially beyond like a POC or pilot, right? Landing that production deal is a very, very long struggle. And that's why I believe, in some ways, investing in fintech startups is really hard. You just don't know who's going to actually break through that noise and get to the other side. So I'm curious how you've been trying to build conviction in the opportunities that you see.
It is hard, because precisely as you say, bank sales cycles are so long and require not only a lot of patience, but in a lot of ways, a lot of capital, right? You have to literally be able to weather the storm. What we have found in some of our more successful portfolio companies is a really unique ability to initially appeal to the faster moving fintechs, the high growth fintechs, right? Who are able to move faster and break things, and then gradually evolve their customer makeup to depend a little bit more heavily on the established traditional financial institution. Because even though it may take you 3 to 5 years to sign Wells Fargo, once you've signed them, chances are they're not going anywhere for a while, right? And so they're a higher quality customer. But it's really important while you're, casting out your line for Wells Fargo to make sure that you do in fact have other lines in the water and are able to sustain yourself with the smaller fish, so to speak. And that doesn't make them less important or less critical to the survival of your business. If anything, I would say the opposite is true. But having both, an eye on the later stage horizon, the enterprise deals, while being able to sign the lower ACV, faster closing deal cycles is really, really important. And that's really what we look for when it comes to building conviction.
Yeah, I mean, it's tricky. I think what you're saying makes a lot of sense. You want to get quick singles and doubles by going to the players like the late stage fintechs that could be customers now or on a sooner time, like a shorter time frame, and you kind of go get that revenue base up. But that quality of revenue is also not very good because they themselves could have struggles and issues, and they might change kind of their vendor base over time. The FIs though, they're the very high quality revenue streams. Once they're on, they're going to be very sticky and very long term as long as you kind of do your core job. But they're very hard to come by, so you have to kind of play in both sandboxes. And I think what I'm hearing is certainly the quality of revenue, particularly from these fast growing AI startups, matters. So not all revenue is treated the same, right? And I'm curious what your take there is, because you have a lot of flash in the pan startups that get to a lot of revenue, but then now the question is, well, how much of that is durable? How much of it's churning? So it's really analyzing the quality of that revenue versus just like the top line revenue numbers.
Absolutely. I mean, that's why we care so much about net dollar retention, about logo retention, right? We want to make sure that your customers aren't just intrigued by what you're offering, but actually find it to be meaningful enough that they're willing to pay you more and more and more over time. I mean, that's the case for any startup, agnostic of industry. It doesn't matter if it's AI or cybersecurity or, I mean, a clothing startup, right? If you're doing your job right, your customers are going to come back to you, and they're going to come back to you for larger and larger purposes. So that's definitely what we're looking for. And then similarly, I think enterprises, because they tend to just have a lot of times more rigorous procurement methods, it tends to be the case that you probably checked more boxes and proved yourself in a more meaningful way if you were able to sign, several Fortune 100s, as opposed to, a bunch of high-flying startups that are themselves very impressive, but, maybe are a little bit playing it a little bit more fast and loose because they actually have business objectives that they're trying to get to and just need to move fast.
Yeah, absolutely. Let's talk a little bit about the regulatory landscape. So you're based in DC. We just had an election. You mentioned earlier that the regulatory landscape is a huge variable for fintechs. I'm curious, the lay of the land, given some of the anticipated regulatory changes or perhaps maybe revisions to some of the policy that we've seen to date. What does that mean for fintech?
Yeah. I mean, I unfortunately am not the expert in this. We just this morning had our second regulatory roller coaster podcast, which I will shamelessly plug here, with Gene Ludwig, who was the comptroller of the currency under President Clinton and is certainly our resident expert in all things regulation. But, I would say that the general sense in the DC office and I think in fintech as a whole is that hopefully regulation becomes a little bit more lax in the coming months, right? There will be more of an interest in actually leveraging technology. And a big part of that is that as budgets get cut, right, you have to rely increasingly on technology to realize those efficiencies that you could not otherwise realize with humans. And so if that is the case, then you actually do need to adopt these types of software that will allow you to do your job in a more cost-effective way. So that is the hope and the dream. Our second hope, obviously, is that banks loosen the purse strings a little bit and recognize that as perhaps interest rates fall, that their deposits could go in a positive direction, right? And so they're going to be a little bit less stingy about their own coffers and will be more interested in actually adopting some of these new technologies. And it doesn't hurt that all of this is happening with the real AI boom, where for the first time in a while, right, it feels as though there's been a real seismic, paradigmatic shift in the way that technology can really augment existing capabilities. So we are positive about that element of what has happened in recent weeks.
Yeah, I mean, there's so many different types of regulation. There's the AI regulation, like how similar will the US policy be to some of the ones in EU, right? And then there's a question of like M&A and regulating some of that. I mean, we've seen some very high profile M&A activity get struck down. And it's felt like, I imagine in the venture community, where if you're a late stage venture of any kind, your exit options are quite limited because there's not good. Yeah. So I'm curious, like maybe on that topic, right? I'm curious if there's more opportunity for liquidity through conventional M&A, maybe exit to public markets as in the form of IPOs. I mean, do you see that changing? Is that has a temperature in the room changed there a little bit?
I think it has. I think there is a little bit more optimism that exits will not be as few and as far in between. We certainly are seeing more M&A. We're seeing more carve-outs, right? Just sort of these individual pieces of the business getting pulled aside because we realize that there are, additional efficiencies that could be realized with a little bit of a debt or an equity injection. And I also think it is too early to tell what the IPO market will look like. In recent days, the market has not necessarily been all that exciting. But as with Trump's previous administration, I think it would be a fool's errand to try to predict too much of what he is going to do, what his cabinet will do, and as a result, what do you call them? Like the ripple effects will be.
Mm-hmm.
So we're all sort of in a wait and see mode. But again, I think optimistic about what the potential for liquidity and exits will look like.
Mm-hmm. Going back to investments, I'm curious if there is any premium to AI these days, or whether AI is kind of a given and you're just assessing based on maybe the core fundamentals of a business.
No, I mean, I think that there is a premium given to AI with the significant caveat that it has to be quote unquote real AI, right? I think that if you look at companies like Together AI, which has broken every record for getting to 100 million ARR faster than any company ever, right? A lot of that is the result of really amazing technology. And so, yes, absolutely, you're going to get a premium for that. I also think, if you invest in a company at 10 billion or 50 billion or $100 billion, there aren't that many companies that then exit for $1 trillion, right? Or even several $100 billion. So there does still need to be a sense of a reality check of what are you actually playing for. So absolutely, the fundamentals of the business still really matter. I think investors are once bitten, twice shy, or at this point, 10 times bitten, 20 times shy about what it means to grow too fast at the expense of, a high burn. Capital is no longer really cheap, and the market is very cyclical. And so for younger investors like me, who joined sort of at the nadir of the market, we've been taught in one way, but for more experienced investors, this is one of 4 or 5 cycles that they've seen over the course of their careers alone, right? So it's just, I think, riding the wave and figuring out what a sensible price looks like and taking the big shots when you feel them.
So AI still has a premium, but fundamentals do matter at the end of the day. I'm curious from your perspective, what type of AI is more durable and viewed with a better lens? So maybe just to give you a frame, the temperature in the room last year was any wrapper around like an OpenAI or similar wasn't really given much of a premium, right? Because they didn't have a depth of model beyond the wrapper build. I think maybe some of that's changed a little bit, where if you build a really incredible application layer on top of that, maybe there's more. But I'm curious what your take on like what defensibility in AI really means.
I mean, I think we've seen a lot of really interesting vertical applications of AI that in some ways, I think it'd be a little unkind to just call them wrappers, but they are hyper specific, right? So AI for tax, AI for accounting, and those don't have to be new foundational models, right? But that is a hyper focused use case in an industry that is ripe for disruption. And I think that that is interesting and potentially defensible based on, depending on the way in which that product was ultimately built. From a pure technology perspective, I think it is fair to say that it is still, the foundational models that are more quote unquote defensible. But as we continuously explore the realm of different foundational models or different security models, the other question that you kind of have to ask yourself is, well, shouldn't it be the case that the original ones were kind of good enough, right? And if everybody's just building wrappers or applications on just a few of these models, sure, you can build your own, but people are kind of going to say, that's great, but we don't need that because we have something else. And if anything, we'd rather you just build the wrapper or the application on top of it. So I think it really depends on, again, the use case that folks are going for. I think building a new model for the sake of building a new model is not the way to go. Just as, building an application that just seems cool and niche is also probably not the way to go. So it's really identifying the pain point and the problem and the buyer persona, and then backwards inducing from that.
When you talk to your LPs, what's their take around build versus buy? Because it feels like a lot of big enterprises like LPs not your LPs, but just financial institutions in general, their initial take was, let's go and experiment, get our hands on the technology, maybe go with existing consulting firms to get reps in, right? Which I think is absolutely the right course because you get much better understanding of how this technology works. But I think there's been more openness to checking out other vendors that are emerging in the space, sometimes to learn, sometimes to get inspired, sometimes to actually make maybe perhaps a purchase decision. But I'm curious what you're starting to see and hear from your LP base.
We're seeing, I would say, a lot more interest in exploring buying, right? I think that with the rapidity of innovation in AI and just frankly, the expense associated with hiring the kind of talent that it would require to build these things in-house, it's just not feasible for a lot of whether it's RLPs or just enterprises in general to really say, hey, we're going to go and hire a world-class AI or AI ML team. And as a result of that, precisely as you said, Ankur, there's at least more openness to the idea of experimenting alongside a third-party vendor. And whether that's just to get inspired and to learn and sort of try to take those learnings back internally, maybe that's the case. But I think at least speaking for RLPs, I would be surprised if a lot of banks really tried to build their own AI layer or even their own AI search engine, right?
Mm-hmm.
Why waste the time, the resource, and the energy to build something when it's pretty readily available elsewhere? Yeah, and we're excited to learn from them and see how we can support both, those FIs and then the startups that are hoping to sell into those FIs along their journey.
I think that's right. It comes down to resourcing and time and effort. And so if someone's built something that you maybe could, let's just say theoretically build in-house, will you save time, dollars? Yeah, and cost, right? Yeah, I think that's right. Because if it's something that's already there ready to purchase and it works and it does a better job than what you could potentially do in-house, you just kind of go and make that decision. So I think awareness of potentially what their options to buy is always really good. And I think that is what's happening right now. And I think in the next year or two, you will see them buy. They will have enough conviction around what it is that they actually need to purchase externally. Maybe they've tried it internally and maybe they haven't found good inroads and are like let's just kind of throw our cards in and actually purchase some of this as opposed to trying to do everything in-house. So I think that will change over time. It's very interesting to see kind of the different phases of the innovation adoption that we're seeing among these FIs. Could you speak perhaps about one of your portfolio companies that have had success, but with maybe your LP base or FIs more generally?
Absolutely. So I think our poster child for this is Alloy, which is a fraud orchestration platform is the easiest way to think about it. And, when I think about young fintechs that really got the mix of customers right at an early stage, Alloy is very much what I think about, right? So they got their start selling to other fintechs and then gradually over time supplanted a lot of those fintechs, not because they kicked them out, but because, as this cycle boomed and busted, some of those fintech customers went away. And luckily, they could fall back on a growing number of large financial institutions and increasingly now credit unions that have seen the real value of a fraud and identity orchestration platform. And what they do so well is they take a large number of disparate data inputs, right, which is what you need to actually make a decision on an onboarding or, an ongoing monitoring customer. And they have a real opinion of, hey, this is the order in which this waterfall needs to go. And this is how you should really set up your fraud system in such a way that will reduce the amount of fraud that you actually see without accidentally throwing false positives and keeping out the good guys. And so, when we first invested in Alloy, I think 2 of our LPs were customers. Today, it's over 24. And so I think it's both a really lovely illustration of the Canapi platform, but then also a really effective fintech that got the marketing and the storytelling right, and then also had a kick-ass product that solved a very real pain point for these overtaxed fraud and identity organizations that were like, we don't know what to do with this wealth of information.
That's an incredible story. I mean, it shows the different cycles, right? Alloy's seen a cycle where there was an implosion among fintechs and they had to go in and get higher quality revenue base, and seeing that's incredible, right? And I think a lot of people forget that the cohort of companies that raised big and were doing well into 2021, they had to go and climb their way out over the last couple of years, and some are really kind of coming out the other end in a very strong position. So yeah, it'll be really interesting to see sort of how all this plays out over the next couple of years as well.
We're very excited.
Maybe to close out some of this, I'm very curious, what is one maybe mistake or one pattern of investment that you maybe have had gone through or made in the past that you've learned from that you're now basically trying to avoid and maybe coaching other newer investors in this space to avoid as well?
Yeah, I think when I first started investing, everything looked kind of shiny, right? And it was difficult to distinguish between the things that were really interesting and the things that were kind of interesting and the things that were just barely interesting. Because I was so afraid of being wrong, I would really try to diligence as much as I could every single thing that I saw. And as a result, you sort of spin cycles on things that are not worth your time, and you aren't able to spend enough meaningful time on the things that you really, really ought to be looking more deeply at. So I think getting to know faster was something that I didn't learn how to do early enough. And of course, you're going to be wrong, right? I think that's a fancy way of saying trust your gut. That's not quite what I'm saying, but it's more that, if you know after the second call, maybe that something's going to be a little bit difficult about this, whether it's getting it through your fund or just yourself getting comfort with it, it is better for everyone, including the founder, if you just let them go early. Mm-hmm. I think that, stringing people along, that slow maybe, is the most painful thing. And so getting to a fast and decisive no is something that probably doesn't happen enough in this industry.
I love that, because from a founder perspective, it's absolutely the best thing as well. You just want to know who's in, who's out.
Right.
Yeah, everyone benefits from that. Well, it's been amazing having you on the show, Lulu. For our audience, where could they learn more about you as well as more about Canapi?
Nothing more to learn about me. So if you want to learn more about Canapi, just go to www.canapi.com. It's CANAPI.com. You can follow us on LinkedIn. You can read our blog. You can learn all there is to know about bank-related fintech.
Amazing. Well, excited to chat more about this in the future as this arena shapes up. But it's been a real pleasure having you on the show.
Thanks so much, Ankur. Really appreciate you having me.